The key question for investors today is what is driving the stock market volatility? Let's go to Yuko Girard on that, Vice President, Portfolio Manager at Scotiabank. Thanks for joining us today. What do you think sparked that deep dive this week?
I think investors are getting a little bit concerned about the very high expensive valuation and some of the names that did very well last year, and looking at the economy and thinking like, is there anywhere else that I could go in, because the upside is getting limited on those names, and there's also this whole talk about the capex and how much they're spending and how much that could actually improve their revenue or their profit margins. So a lot of concerns on those names that did well, and then they're looking at other areas. The other volatility probably is coming from the AI impact, and outside of even the tech or software companies, like other areas that AI might kind of take over their business or really kind of impact them negatively.
Okay, despite the volatility, you do expect 2026 to be positive for the markets. What are you basing this on?
I think it's more on the economic indicators, and economic backdrop is pretty, solid. Like when we usually monitor a lot of the leading indicators, and whether it's the PMI or whether it's the GDP growth, and also inflation and labor. Like when we look at those, the actual numbers are actually better than a couple of years ago. So the recession risk for us is lower. Now, this is more tied to the earning growth. So the company is probably going to have a better or solid earning growth, but the multiples, this is where we don't know, because the investor sentiment can be, different than like you saw, that year to date. It is impacting the multiples, and that is impacting the price.
Okay, so what else would be a risk to growth in 2026?
I think, we saw good job data and inflation numbers from the U.S. This week, which was a good news. But if that changes and it actually is worse than expectation, which kind of leads to a different policy decision, that's one thing. The geopolitics is always going to be another, risk. And also we have these trade, it's still not done yet, right? Like tariff was a big, talk last year. We still see that coming, here and there. And so anytime those kind of a news comes up, I think it's going to add volatility. And depending on how it's implemented, and it can affect the market.
Okay, I know that you like materials and energy right now, but can you drill down on both for me, why you're looking where you are?
I mean, it doesn't mean I really like it. It's like in the TSX did very well last year, and the majority was really coming from the precious metal stocks. Given the, still the uncertainties and the geopolitical risk, I think those themes are continuing to do okay or well within the TSX. So given that, energy and material has done year to date fairly well, that will hold up the TSX well. But yeah, I don't really prefer that sectors, because it is not the best sectors to hold in for the longer term investors, and our active managers tend to be underweight in those areas.
Okay, we talked about investors' concerns about AI and what businesses are at risk. Investors clearly spoke about some of that. What AI exposed names do you see as winners in the longer run?
Yeah, I think this is the place where you really have to differentiate the high quality names and versus the more the if you look at the balance sheet, weak balance sheet, and you need to really kind of look at why they're being impacted and why the price is going down. And something like Microsoft, I know it was impacted quite negatively, especially after the earning release because of their capex spending. But I think those are names that are actually in the long run very good name and could be a buying opportunity right now because the prices went down so much.
Does that mean with some of the other mega caps you are diversifying away from them, or are you still holding some of the others as well?
It depends on the portfolios, but in general, we held those names, but we were never overweight on those names because we always wanted to diversify, and actually our diversified portfolios, especially in the U.S., is doing much better. And like equal weight versus the cap, market cap weighting index, you can see the equal weight is doing better. So I think the leadership is really broadening, and the diversification is really working. Especially like in the U.S., that's what we think in the 2026.
Okay, are there pockets, Yuko, where you think there are opportunities that perhaps investors are overlooking right now?
I think there's a lot of names in the industrials that really got punished last year because of the multiple reset, but they're really a good quality companies. And I think once they realize that, now that it's actually in a reasonable valuation, that those are the areas that can benefit from this broadening of the leadership.
When you are talking about diversifying out, as you mentioned in the U.S., what are you diversifying to?
I think there's a lot of areas like I said, there's industrials and consumers. We need to be a little careful because we saw some not too good retail numbers. I think consumers still buying, but there's this K-shaped economy in U.S. where the lower income consumers are struggling, and even though inflation is now kind of under control, it's still everything is already expensive. So consumer discretion is an area that probably is not the best area, but even like the staples, like it's very defensive in this kind of volatile market. Maybe it's not a bad place to actually put some money in.
Got it. Yuko Girard is Vice President and Portfolio Manager at Scotiabank. Thanks for your time.